the US and China, imposition of new rounds of sanctions on Iran, breakdown of Brexit negotiations, a new wave of tension on Korean Peninsula, vulnerabilities in major financial markets, and rising public and private debt in some emerging market and developing economies. Despite these uncertainties, inflation in the advanced economies remain muted and largely below their 2% long-run targets. As a result, most central banks in the advanced economies, including the Fed, the Bank of England, and the European Central Bank, adopted a dovish monetary policy stance, which is expected to remain in place in the near to medium term as signs of weakness in the global economy re-emerged. In the emerging markets and developing economies, however, developments were mixed, with inflation rising in some, but moderating in others. In response, the financial markets witnessed the rebalancing of portfolios from equities to fixed income securities, and some stock markets posting losses. In the main, the emerging markets and developing economies are expected to continue to benefit from the accommodative monetary policy stance of the advanced economies through increased capital flows. The domestic output developments. Available output data from the National Bureau of Statistics, NBS, showed that real gross domestic product, the GDP, grew by 2.01% in the first quarter of 2019, compared with 2.38% and 1.89% in the previous and corresponding quarters of 2018. This was largely driven by the non-oil sector, which grew by 2.47% in the first quarter of 2019, while the oil sector contracted by 2.4%. Staff projections indicate that real GDP growth of 2.34% and 2.36% during the second and third quarter of 2019, respectively, including a reduction in the unemployment rate. The Monetary Policy Committee observed that actual output remains below potential, implying that the economy still had sufficient headroom for inflationary growth. This is expected to be driven largely by sustained stability in the financial system, continued special interventions in the agriculture, manufacturing, and the SME sectors by the bank, sustained effort in improving transport infrastructure to address distribution challenges, continued expansion of business activities as indicated by the PMI, and increased supply of foreign exchange to growth-stimulating sectors, among others. The committee noted the continued expansion of the manufacturing and non-manufacturing purchasing managers' indices for the 25th and the 24th consecutive months in April, and broadly welcomed this positive development in the economic activities in Nigeria. The manufacturing PMI grew by 57.7 index points compared to 57.4 index points in the previous month. Similarly, non-manufacturing PMI grew by 58.7 index points compared to 58.5% points in March 2019. The growth in both measures of PMI were anchored by marginal increases in production, employment level, and new orders. Developments in money and prices. The committee noted the growth in broad money supply M3 by 5.42% in April 2019 from the level at the end of December 2018, annualized to 16.36% above the indicative benchmark rate of 14.47% for 2019. This was largely driven by the growth of 19.62% in the net domestic credit NDA, and in contrast, net foreign assets contracted by 5.83% in April 2019 relative to the level at the end of December 2018. In spite of the significant underperformance of the M1 at minus 4.26% annualized to minus 12.77%, M2 grew by 1.85% in April 2019, annualized to 5.54%, which was significantly below the benchmark rate of 12.99% for 2019. This development was largely due to the growth in time and savings deposits by 6.53%. The net domestic credit, NDC, grew by 19.31% in April 2019 from the level at the end of December 2018, annualized to 57.92%, and was above its indicative benchmark of 11.82%. The growth in NDC, net domestic credit, was attributed to the significant increase in credit to both government and the private sector by 64.4% and 9.6% respectively in April 2019, compared with December 2018. The committee noted the developments in the monetary aggregates and enjoined the bank to initiate moves towards improving lending to the private sector and urged other intermediary institutions in the financial sector to support these initiatives by improving their credit delivery to boost output growth. The committee noted the uptick in inflation as headline inflation rose slightly to 11.37% in April 2019 from 11.25% in March 2019. The increase in headline inflation was driven mainly by food inflation, which rose by 13.7% in April 2019 from 13.45% in March 2019. Core inflation, however, declined marginally to 9.28% in April from 9.46% in March of 2019. In April 2019, month-on-month inflation headline food and core inflation increased to 0.94, 1.14, and 0.70% from 0.79, 0.88, and 0.53% in March 2019, respectively. The Monetary Policy Committee noted that the recent uptick in inflationary pressure was seasonally driven and anticipated. Liquidity conditions in the banking system reflected the net impact of the open market operations auction, maturing CBN bills, statutory allocations to states and local governments, as well as interventions by the CBN in the foreign exchange market. Consequently, the monthly weighted average interbank call and open buyback rates increased to 13.98 and 16.15% in April 2019 from 10.8 and 12.17% in March 2019, respectively. The daily unsecured interbank and the open buyback rate fluctuated within the standing facilities corridor, closing at 6.57% and 5.55% on May the 10th and May the 16th, 2019, respectively, reflecting the reaction of the money market to the 50 basis points reduction in the policy rate at the meeting of the MPC in March of 2019.